All right, it's your Uncle Ed. Guess what? Fed Day. Chairman Powell has spoken, and wow. Okay. A few things to unpack here really quickly. So they talked about doing 2 potential Fed rate cuts. Keep in mind that last year, 2024, they did 3. So now the forecast is to do 2, but it's not going to come in May. So it's going to be later on down the line. Now keep in mind, just as a reminder, that the federal funds rate is short-term rates. It does not have a direct impact with mortgage rates. So that when that rate goes down, it doesn't mean that rates go down immediately, right? So if the rate goes down a quarter point, doesn't mean that mortgage rates go down a quarter point. Does it influence or have a longer-term effect? Of course it does, because every bit of the economy is interconnected, and so they do spill over. The second piece is the Fed's forecast of basically the economic growth, or through GDP, which is the gross domestic product, went from 2.3 to 1.7%. What does that mean? The Fed just feels like the economy is slowing down, right? Now, what is the big question mark? Yep, the T word, the bad T word, tariffs. That's probably why they're not dropping rates, is because they don't know if and when these tariffs are going to have an effect, or how much of an effect they're going to have on inflation. Will prices continue to go up, or is that going to be transitory, meaning it's not going to be that big of a deal? Well, we're all asking that question, right? If prices are going to go up, are eggs still going to be skyrocketed, right? No, I don't think there's going to be a ton of inflation. So hopefully, right, I'm fingers crossed, because I'm always a positive person. I think that hopefully inflation will continue to be tamed, because it hasn't gone up tremendously. And so the Fed most likely will achieve their 2% core PCE, which is the personal consumption and expenditures report, which is their favorite measure, as Chairman Powell said, in 2027. So for now, get used to these rates. This is where we're at. And I got to tell you, this is where you're going to hear this term again. As much as I hate it, it's date the rate and marry the property. What does that mean? Go get a good deal on a home. You're going to refinance later. It's a fact. When rates come down, whether it be high fives, or I just realized I said high fives, or the low sixes, you're going to refinance regardless. But by then, you will have paid Uncle Sam less in taxes, because you get to write off the mortgage interest and up to $10,000 of property taxes. And you will have been given equity that you currently are not doing. Right now, you're basically a part-time worker for Uncle Sam. According to the statistics, the average employee in this country works to pay taxes 4 months out of the year. And of course, you're not building any kind of legacy wealth. Your landlord is, because you are renting and you don't own. When you own, you get the 4 to 6% that we're averaging right now. Appreciation on that home is your equity. So what side of the coin are you? If you don't know, or you want to have a strategy to stop paying the IRS so much money and to start building some legacy wealth, that's where you call me. The consultations are always free. Have a great day.